Hi, this is Ada Piederico from Alpha Investing, and it's a real pleasure to be with you here today to give this presentation on the fundamentals of underwriting commercial real estate. So I'm going to share my screen here in a second, and we will get to it. If you have a pen and a paper, I would suggest having that handy. You'll want to take notes. We're going to go high level, but we're also really going to get in depth into some specifics, get really detailed, because as Ann Lynn, our head of underwriting, always says, the devil is in the details. So let's get started. All right. So again, the presentation is the fundamentals of underwriting commercial real estate. And Alpha Investing, to give you just a quick background about who we are and why we're presenting. We are a private capital network that connects accredited and professional investors to institutional quality, pre-vetted private real estate investment opportunities. Our team is comprised of 5 senior leaders, of which I am one. And our track record really quickly is we have underwritten, presented, and raised capital for 45 properties, totaling $1.5 billion in capitalization across 18 states. And our average cash-on-cash return across the portfolio is about 8 to 9%. And what I do want to say is, as we get into this presentation, that underwriting real estate opportunities is what we do all day, every day as a profession. And this is something we put a huge emphasis on. And there are 3 main categories that we're looking at. So I'm going to share with you our underwriting strategy and our process. And it starts with identifying and vetting high quality sponsors, analyzing market trends, and underwriting and evaluating deals. So let's start with the sponsor. The sponsor really is the key to success of any real estate investment. And where and how you are introduced to a sponsor matters. We are a sponsor-first company, and we strive to establish the right partnerships with a small group of high-quality sponsors and then invest with them on a recurring basis. We source our sponsors from our network. And when we get into it, beyond how you're introduced to a sponsor and how you get to know them, there's an analysis, review, and an evaluation procedure. So when we're looking at a sponsor, we're evaluating and thoroughly vetting every single one before we even consider the merits of their investments. This is because the sponsor manages the day-to-day operation at the property and is ultimately the one that's responsible for carrying out the business plan. So in our case, Alpha Investing's team is actively monitoring the performance of every asset, and you as an investor would be doing the same. But the sponsor is the one who is directly managing those operations and driving performance, which is the key to an investment's success, particularly in today's market. Experience matters more than ever. So first, we're identifying a sponsor's investment strategy, which is formed by their view of the market and will often dictate the geography, asset type, and return profile in any investments that they're targeting. We look for alignment with our views on where we are in the market cycle. We evaluate a sponsor's experience and track record, and specifically as it relates to their current strategy. We evaluate the dollar amount of assets managed, typically requiring several hundreds of thousands of assets under management. And in addition to asset volume, we evaluate asset performance of the sponsor's existing and historical portfolio. There, we're looking for a proven ability to achieve consistent returns. Once we're comfortable with the sponsor's ability to operate and perform, we evaluate and negotiate the economic terms, making a split that aligns sponsor and investor interests and incentivizes the sponsor to maximize returns. And this is achieved by making sure that the sponsors participate meaningfully in every single transaction, and that their upside is paid only after investors have first received a predetermined return and a full return of capital. In other words, sponsors must have skin in the game, and alignment is the name of that game. So now let's get into some of the specifics on what to look for and how to vet a sponsor. So first off, track record. We thoroughly review a portfolio's performance, both realized and active transactions. So what does that look like? It looks like total transactional experience, the number of assets, total asset value. For us, we're generally focusing on sponsors with 500 million or more of transactional experience. You're looking at the performance of the portfolio, realized and active transactions, with a focus on the underwriting versus actual performance. So how did a realized project perform compared to underwriting projections? Some of the documents that you want to be asking for are company deck, financials, the underwriting model, past deal summaries. Next, experience, reviewing the background of the principals, and particularly for sponsors who were founded after the Great Recession, they founded a new company after the Great Recession. We want to make sure we understand the principals' prior experience before the founding of their current firm. Some documents to ask for include a company deck, resumes, and any other professional records. Now, expertise. So you're evaluating the sponsor's asset class and geographic expertise. So for example, if a sponsor has decades of core multifamily experience and is now looking to branch out into value add multifamily, that's a different experience for the sponsor. So we want to see how they're thinking about that new strategy. And this is particularly important if a sponsor is shifting into a different asset class altogether, because it's one thing to have decades of experience in multifamily, and it's another to have it in hotel or going into hotel, especially these days. So maybe that wasn't the best example, but you know where I'm going. And some of the documents that you want to be asking for when it comes to the expertise category is track record documentation, and an investment thesis for the new geography or asset class or strategy. Next up, we are in relationships. This is so important. So some additional considerations are the sponsor's relationships with brokers, lenders, and vendors. We're evaluating the quality of their existing capital relationships, both on the equity and the debt side. Higher quality debt and equity relationships speak to a more institutional quality sponsorship. So for example, in today's competitive environment where there's a lot of capital chasing deals, local relationships can sometimes create opportunities to transact off market, which avoids competitive bidding wars that drive up pricing. Also, when we're talking about that ever important lender relationship, it can lead to better than market debt terms and with less restrictive covenants. And that makes an investment opportunity more compelling. Lower debt, higher returns, generally speaking. And it can also shorten the time of the lender's diligence and provide surety of close, which makes the sponsor's purchase offer more attractive to the seller. Next up, we will talk about references. So speak to investor references, preferably professional investors. Triage with other people in your network who may know or work with the sponsor. Check user and tenant reviews on Google or other similar searches. Reporting. This is very important. We really evaluate the quality of the sponsor's reporting. For example, investment memos. Are they well presented with asset overview and business plan? Do they include a detailed description of the CapEx program, CapEx being capital expenditures? Do they include relevant breakdowns of unit mix, rent premium projections, managerial efficiencies? Does their reporting include sources and uses, a pro forma, track record, renovation, before and after photos, sale and rent comps? We're looking for comprehensive market information, including MSA rent growth, occupancy, employment centers and job growth, and the attractiveness of the neighborhood. In reporting, how detailed is it? All those things I just listed off, how detailed is their reporting? So, for example, are they giving updates on their CapEx status with photos? So before and after, how much did it cost to renovate the units? Are they on target? Rent comparison on their renovated units versus what they came in at and what the market is at. Underwriting comps, detailed P&L and other accounting reports on a consistent basis. Reporting and how a sponsor reports is extremely important. Are they proactive in explaining their progress and their early results of their CapEx programs? And, are they adjusting the business plan in response to the very dynamic factors at each asset? And how are they communicating the reasoning behind the reporting? So next up, property visits. This is pretty self-explanatory, but we're really talking about visiting other current properties in the sponsor's portfolio. Visit comps in those areas as well. Check for the quality of work when you're at the building. Speak with tenants if you can, neighbors and locals. And last but not least, on the sponsors, we have here intangibles. So, other considerations via conversations and interactions. And I touched on a little bit of that with the reporting. So, there's a lot to be said about these intangibles. And you're certainly not going to dismiss a sponsor just based on intangibles. That's why we're presenting, these 8 major buckets that we look at. However, intangibles are things like a sponsor's responsiveness. It's their transparency. How do they answer questions? Drive, proactivity. Are they driven in what they do, or are they kind of lax in getting back to you, in how they present their information? And intangibles are a little bit of this gut feeling, the feeling that you get intuitively about a person or a company. And this is really important because as you're looking to build a long-term relationship with sponsors, this becomes really important. Do you trust them? Do they seem trustworthy? And intangibles come from experience in underwriting and working with sponsors. So it's domain expertise. The more projects you look at, the more sponsors you work with or talk to, the more you're building this unconscious and pre-conscious database of information that you're using every time you talk to someone else. So intangibles, like I said, they don't make or break a deal, because they need to be considered in the overall strategy that includes everything mentioned above. But these are things that really do matter. So don't write something off if all the numbers make sense, because you can make the numbers say anything. But if something about the way the sponsor behaves, reports, treats you, if that sends you a red flag of some kind, give it some credence and really look into it. And then I would say that really comes back to the references at that point in the relationships. If there's something that feels off to you, check it out. So as you can see, we do spend a significant amount of time upfront on sponsor diligence and building a relationship with the sponsor's key principles. That strategy for us at Alpha Investing is important because we want to be recurring capital partners to a group of carefully curated sponsors. And we believe the benefits of this approach are that we become very familiar with the way the sponsor operates and a general sense of appetite and return profile for future deal flow, and that we have a direct line of communication into the sponsor. So let's move on to market trends and macroeconomics. So I won't spend much time talking about the market, but here are a few things to consider because when we evaluate an investment at a high level, we're really focused on the market and on the business plan. The market is something that the sponsor has little to no control over, right? But it can greatly impact an investment's returns and performance. We therefore spend a significant amount of time evaluating the market. But like I said, I really want to get and spend more time on the deal metrics. So just really quickly, some of the things that we look at are asset values, cap rates, the labor market, interest rates, supply and demand, demographics. So a quick example, asset pricing has been at all-time highs and exceeded pre-recession peaks in most markets before COVID. And now even through COVID and post-COVID, there's a lot of uncertainty. And we believe that future growth will continue to be more moderate. And therefore, we are looking at markets that can benefit from the shifts occurring in population migration, demographics changes. So for example, some of the markets that are experiencing stronger job growth and economic growth, and where that growth can be expected to continue. So the labor and economic growth side really informs the demand for commercial real estate. On the other side of the equation is supply. So if a supply outpaces growth, you could still see a softening market, even though jobs are growing there. In that instance, you'd be better off in a market with slower growth, but no new supply. So while macroeconomic market factors are important and must be taken into consideration, because this is asset-based investing, a major emphasis goes into what we call the micro factors, down to the street level of where an asset is located. And this level of detail is necessary for evaluating a correct risk-adjusted return at any point in the cycle. So moving on to deals and asset-based investment strategy, you can see solvable issues, downside protection, and risk-adjusted returns. So the area that a sponsor does have control over is the business plan. So as a first step, we seek to validate the purchase price and total capitalization, which includes the cost of additional planned capital expenditures or CapEx. And the acquisition price is largely a factor of prevailing cap rates. So as previously described, sometimes sponsors with local relationships are able to purchase investments off market, which lead to better than market cap rates. And when we evaluate the investment business plan, we're looking for these solvable issues with specific actionable strategies where the results are not fully reliant on these market conditions. We're also focused on appropriate risk-adjusted returns, and we're placing a lot of emphasis on downside protection, particularly considering where we are today in the market cycle. And downside protection can be achieved in several ways. Examples are buying off market at above market cap rates, looking for investments with solvable issues, and an action path to improve an asset that's not tied to market conditions, and seeking investments that have current cash flow, which reduces the reliance on the exit to generate returns. So let's get into the specifics of how to do deal due diligence. So first off, in the specifics of deal due diligence, we start with the business plan. So you're looking to get a thorough understanding of the business plan and how the sponsor intends to create value. You're looking for solvable issues with specific actionable strategies where the results are not fully reliant on market conditions. Some examples of this include reducing expenses and operating more efficiently, improving revenue through a more hands-on management, or by physically improving the asset for example, renovations and rent increases, operational efficiencies and expense decreases, or a combination of both. Some documents you want to be looking for are the broker offering memo, the sponsor investment memo, and the sponsor's underwriting model. Next, you want to look at the financial position of the asset. You're looking at rent roll and doing a lease audit, reviewing the current rent roll and historical financials to get a clear understanding of the financial position of the property. You could do a tenant audit, and some of the documents you want to be looking for here are historical financials. Next up is the physical condition of the property. Again, this one's self-explanatory, which is reviewing property condition reports to get a clear understanding of the physical condition of the asset. If possible, go see the asset, walk it, go walk the neighborhood, also go look at the comps. So when you're evaluating the sponsor, you're doing that for their existing portfolio. When you're evaluating a property to invest in, you're doing it for the specific property. And some of the documents you want to be asking for getting are appraisal, environmental reports, property condition reports, flood or earthquake insurance, easements, photos. So there's a lot there, and really understanding what's the physical condition of the property. Then we move on to the underwriting model. Now, again, this is going to be a big, important chunk of doing the overall vetting of a project. So you want to be thoroughly reviewing the sponsor's underwriting model with an emphasis on scrutinizing the sponsor's assumptions on both the revenue and the expense side. So for example, some questions that you want to be asking: are renovation premiums achievable? How do they compare to competing properties in the submarket? How quickly can a sponsor renovate units in order to achieve those premiums? Are their occupancy assumptions reasonable? What are they projecting for organic rent growth? Are there projections for controllable expenses such as payroll, marketing, leasing, repairs, utilities, maintenance? Are all of those supported by the financial performance we see at other assets in their portfolio? More questions: are they able to provide objective support for their projections for uncontrollable expenses, such as insurance and real estate taxes? And are they projecting appropriate expense growth throughout the life of the project? All of these make a huge difference in the overall returns and the risk-adjusted basis of those returns on a project. And in assessing the reasonableness of the assumptions, you want to be reviewing third-party market reports to understand historical and projected rent and occupancy trends in that submarket. As I mentioned before, under physical condition, complete a site visit on a case-by-case basis, especially for a new sponsor or in a new market. What's also important is to ensure that you understand and assess the sustainability of the demand drivers in the market. So like we talked about with the market trends, evaluating new supply coming online and determining if it's competitive with your asset or complementary to it. Some of the documents that you want to be looking at with the underwriting model, of course, in addition to the sponsor's underwriting model and running your own with your assumptions, is market reports, expense comps, rent comps, property tax bill, insurance documents. Those are all really important. This is the nitty gritty. This is the devil is in the details. Moving on to capital structure. What do I mean by that? I mean, how is the transaction capitalized? Who's putting in equity? What's the leverage? Who's the lender? What's the interest rate and term on the loan? And when it comes to who is the lender, does the sponsor have a pre-existing relationship with this lender, or is it a new relationship? What is the in-place debt service coverage ratio? This is a really important number, especially these days. You're also looking at what kind of interest reserves is the lender looking for? And here's something that we're placing a huge emphasis on currently and for the foreseeable future. How far can an existing income of a property fall before the property can no longer maintain debt service? So, in other words, how much revenue can be lost before the lender forecloses? An important document here under capital structure is going to be your debt term sheet. So these are some of the things that we're looking at very closely, and based on our view of the various assumptions, and you as well, perform detailed sensitivity and scenario analyses to understand what projected returns look like under different assumptions. Generally speaking, a low, mid, or reasonable, and then a high assumption. And this ensures that the asset class can weather potential negative eventualities. And if you're going to pick one of the scenarios, pick on the lower side, be more conservative, especially in this current environment. Stress test the property to determine break-even points under those various assumptions. And very importantly here, ensure that there is sufficient downside protection in the deal. Other considerations: what is the projected sale price of the asset compared to the purchase price? What exit cap rate is the sponsor using? How does the purchase price compare to the replacement cost? And how does the projected sales price compare to today's replacement cost? All right, last but certainly not least is the legal review. Performing a thorough review of all legal documents pertaining to the transaction. Work with a real estate attorney if you must. Reviewing legal documents, debt term sheet, purchase and sale agreement, operating and subscription agreements. Documents to ask for. I kind of mentioned a few: your PSA, debt term sheet, the property management agreement, the operating agreement, the subscription agreement. So these are all very, very important documents for your legal review. And that is a quick and dirty but detailed look at these 6 major buckets when you're doing diligence on deals. All right. So today, we've looked at the many, many elements that go into thoroughly underwriting a commercial real estate investment opportunity. So to briefly recap, we covered underwriting the sponsor, the market, and the deal itself. We covered both high level and details so that you can walk away armed with the information, questions, and knowledge that you need to perform your own underwriting on commercial real estate deals, or at the very least, to meaningfully participate in conversations with sponsors and syndicators. Thank you so much for watching the fundamentals of underwriting commercial real estate. I am Adapia Dorico. Oh no. And you can connect with me at adapia@alphai.com. And if you would like to request access or schedule an introductory call, please go to investors@alphai.com. And thanks again, and enjoy the rest of PIMCon 2020. And I really hope to hear from you soon. Bye.